In an unexpected turn of events, the Dow Jones Industrial Average has taken a dive, dropping over 1,100 points. This historic plunge marks the longest losing streak the Dow has seen since 1974. The Federal Reserve's outlook played a significant role in this downturn, leaving investors hanging on a less than promising forecast. In a twist of events, the Fed indicated only 2 interest rate cuts for 2025, a sharp contrast to the 4 cuts that were previously anticipated. This change in course led to a 2.6% drop in the Dow, leaving investors and market watchers reeling. The downturn, a first in 10 consecutive days, didn't come without its triggers. Rising concerns over inflation and the tightening of monetary policy played a significant role in this historic plunge. This is the first decline in 10 consecutive days, triggered by rising concerns over inflation and monetary policy tightening. Despite the tumble, the Dow remains up 14% for the year. However, not all companies have managed to stay afloat. 2 of the major players, United Health Group and Nvidia, have experienced significant declines, contributing to the recent downturn. Let's delve a bit deeper. United Health Group, a forerunner in the healthcare sector, has seen its shares tumble. This dip in performance not only affects the company's standing, but also influences the overall health sector's performance. Its downturn sends a warning to investors about potential risks in the healthcare industry. On the tech front, Nvidia's decline is another blow to the Dow. As a leading chipmaker, Nvidia's performance often serves as a barometer for the tech sector. Its decline could signal potential headwinds for other tech companies. These declines are not isolated events. They are interconnected. A decline in major players like United Health Group or Nvidia can shift the balance in their respective sectors, creating a domino effect that can impact the entire market. It's like a ripple effect in a pond. When a major player stumbles, the waves can reach far and wide, affecting various aspects of the market. This is why investors keep a close eye on these key companies. Their performance can provide valuable insights into market trends and potential investment risks. These declines have sent ripples through the market, with investors anxiously watching the performance of these key companies. The market's reaction to the Fed's unexpected stance on future rate cuts was swift and severe. As news of the Federal Reserve's outlook hit the wires, stocks and bonds took a sharp nosedive. Why such a dramatic reaction, you ask? Well, it's all about investor sentiment. You see, the market is like a giant mood ring, constantly changing colors based on the collective emotions of investors. And when the Fed announced only 2 interest rate cuts in 2025 instead of the previously expected 4, it sent shockwaves through the market. The mood ring turned a worried shade of blue. Investors had been banking on those extra cuts to boost the economy. Fewer cuts could mean slower growth, and that's a scary prospect for folks with money in the game. So they reacted, pulling their money out of stocks and bonds, leading to the sharp decline we've seen. But it's not just about the immediate financial impact. This shift in the Fed's stance has sparked concerns about the future of the economy. Investors are now questioning whether the current monetary policy is sustainable. And uncertainty, my friends, is the arch nemesis of the stock market. So what we're seeing is a reflection of these concerns. It's a ripple effect that started with the Fed's announcement and is now spreading through the market, causing waves of selling and price drops. As the market continues to react to the Fed's stance, investors are left wondering what the future holds for the Dow. After all, in the world of finance, as goes the Dow, so goes the nation. And right now it seems like we're all on a roller coaster ride, holding on tight and hoping for the best. In the wake of this historic decline, the question on everyone's mind is, what's next? This downturn has certainly sent shockwaves through the market, casting a shadow of uncertainty over future economic prospects. A key factor to watch is the Federal Reserve's stance on future interest rate cuts. The Fed's unexpected forecast of only 2 cuts in 2025, as opposed to the previously expected 4, was a major contributor to the Dow's decline. This change in monetary policy could stir up further market volatility as investors grapple with the implications of tighter financial conditions. The potential for inflation, coupled with a more restrictive monetary policy, could lead to a challenging environment for businesses and consumers alike. The Dow's recent downturn, despite its robust overall annual performance, has also raised questions about the resilience of the market in the face of adversity. Will the market bounce back? Or is this the beginning of a larger downward trend? Only time will tell, but for now the market remains a landscape of uncertainty, and navigating it will require careful planning and strategic decision-making. As we move forward, all eyes will be on the Dow Jones, the Federal Reserve, and the wider market, as investors brace for what could be a bumpy ride.